Well, hello and welcome everyone to this Right Capital CFP CE certified webinar on adapting financial planning strategies to volatile inflation. My name is Daniel Gregoire. It's a pleasure to be with all of you here today to really work through what's a very timely topic, I know, for a lot of your clients. And even this morning, waking up, I saw a headline from USA Today that said, is the US getting too expensive to live in? Many Americans worried about the economy and inflation specifically. So really, we know that over the past, let's say probably 2 years now, and talks about inflation have been, very front and center with the headlines. So the ability for all of you to work within the context of, a financial plan to address maybe questions around volatile inflation is really important. So that's really why we're all here today, to talk not only through, some historical data and talk about different strategies we can use to combat inflation, but more specifically as well, how can you use a tool like Right Capital, as the visual backdrop to help clients understand the benefits of different strategies and helping them to understand the why behind your recommendations. So this is a CFP CE certified webinar, meaning we do have some content we're going to get through today before we pivot over to Right Capital software. But I promise we'll make that pivot and talk through all of these strategies again within the context of a planning tool, so you can see how all of this would map out. And as well, we want to show you maybe what a typical analysis and report might look like. But with that being said, for those of you who are CFPs, we will be issuing the CFP CE credit on your behalf as long as you entered your as long as you entered your CFP ID upon registering for this webinar today. If you did not, you can always send a follow-up email to the email that'll get sent out tomorrow with the recording of this webinar. So all of this will be recorded and sent to you after the fact, as well as we're going to include a certificate for anyone who maybe wants to apply credit for other certifications. In addition to that, I welcome any questions that you have as we go through the content today. We'll stick to the content just to get through it for our allotted time slot. And then at the end, we'll open it up to Q&A. If you do have questions, please leverage the GoToWebinar control panel under the questions drop-down menu to communicate with me. We won't be able to turn your audio on just because of the sheer number of attendees today, but we'll certainly be able to answer questions that you type into us. So with all that housekeeping out of the way, I'm excited today to talk about how we can all, adapt financial planning strategies to volatile inflation. And certainly, this is a topic that clients may be talking to you about currently, or you might be working with your clients currently on. But knowing, today, why it's so important within the context of a financial plan for both pre-retirees and post-retirees is going to be a big part of this. So we want to really stress, the impact that different inflation scenarios can have on clients. And then we also want to talk about how are you as an advisor mapping this data into the future, because it's important not only for us to be able to, of course, use maybe the defaults within the actual system to project data, but what if you want to change those? Or what if you want to propose hypothetical scenarios if inflation is higher or healthcare costs are higher? And what are the best ways to do that? And then apply the strategies that you can recommend to clients to really ultimately help them achieve better results for the long term. So we're going to talk through that, and we again want to provide some context behind some of the data that you maybe have as assumptions within Right Capital. We then are going to get into the meat of this, which are the strategies that you can leverage for managing the impacts of inflation within your clients' ability to fund their financial goals in the future, or make sure they can live to the end of their life without running out of money, making sure they can still retire on time and when they were hoping for. So all of this is going to kind of work together to both kind of set the tone for what we have and what you can use in Right Capital to map data into the future. We'll talk about how to address some of those common questions that you'll receive from clients, and how to essentially use a typical case study for a pre-retiree that we're going to go through to review the impact of inflation and the impact of those strategies that you can use to manage it over time. So let's dive in, and we're going to start simple, but we'll work our way up, I promise. So, we know that inflation itself is the erosion of real purchasing power of wealth, where essentially every dollar saved can buy less over time. And we know that in terms of building a financial plan that projects data 30, 40, 50 years into the future, there's a lot of important factors, but inflation is one of the most important ones because it's going to be really important to align your unique beliefs, whether you're relying on historical data or other market indicators to essentially map this data into the future and help clients better understand your position and how you can help them. And these values for inflation, we see it in the headlines constantly, but they're typically evaluated through changes year to year in the consumer price index and the wholesale price index. So when it comes to actually measuring, inflation, we know that the past few years have been rocky. And although we see this coming down a little bit, we know that we're still not out of the woods yet. We know that with stimulus funds a few years back, hitting the market, we saw increased inflation. With the pandemic supply shortages, we of course saw some additional inflation. With the geopolitical tensions we have currently, maybe with the war in Ukraine or other scenarios, we can see, of course, inflation rising, or was rising, I'll say. And as well, we see, quantitative easing where, there's an abundance of cash essentially chasing fewer products, pushing the prices higher, all helping to drive inflation over the past few years to a place where we haven't seen it for decades. So this is a top of mind topic for your clients. It is something that using a tool like Right Capital or others can really help to, project your strategies and show the value in your strategies, whether it's your AUM clients looking for advice or whether it's fee for service clients who you're working with just for this specific conversation. There is no shortage of opportunities here to navigate these types of conversations. And when it comes to, why it's so important for people to take this into consideration is, of course, we know that retirement is not the goal line. It's not the end line for a financial plan. We want to make sure that as we maybe see increasing longevity or maybe adjustments to Social Security, for example, we want to make sure that clients can still fund their goals. They can still retire when they want to. They can still leave the legacy they were hoping to. And all of this is a really important part of the conversation of why inflation matters. And we know there's a lot of unknowns in the future. We know Social Security might have some changes coming up down the road. We also know that before the pandemic, we saw longevity just continuing to increase year after year. So plans were becoming, longer that the clients are trying to fund after retirement. But even minor changes to inflation in the near term can have major implications for those long-term planning goals. Can we fund the children's college education? Can we take those vacations we were hoping to for the 10 years after retirement we wanted? So all of this can really come together within, a comprehensive financial plan to really demonstrate, again, the value of your recommendations to the clients. Now, we also know that the financial plan itself is a staple in our industry. So having that output is something that's really going to be an important part of the value that you provide to clients, both for compliance reasons and for documenting the different changes that are being made for clients year after year. But also, it's there to essentially make sure that the clients have faith in your processes. But understanding the implications of, and the complexities of retirement spending and inflation, and understanding how much the clients will need to save today to keep pace with future income needs can be very difficult. So there are certain ways that we can use these, planning tools like Right Capital to actually better accommodate the recommendations that you're making in real time if there were to be, let's say, volatile markets or increased inflation. So with these different scenarios, there are certain tips and tricks for recommending tools that essentially follow your normal recommendations you'd make in real time as you project information 30, 40, 50 years into the future. So again, we'll weave that into the conversation in a little bit. But I will, say that part of this and one of the hardest parts of this conversation is the unknown. We know that we have historical data for inflation. What we don't know is what inflation will look like 30, 40, 50 years down the road. We have market indicators for maybe a little more near term, but for the moment, we have to make some assumptions when we're talking about what does it look like for the future. And ultimately that can be a difficult conversation to have, but having a basis for that, whether it's in historical data or whether that's in 5 or 10-year forward projections, can help you better explain that to clients moving forward. But we know that the most typical questions we might be faced are, how long or how will this maybe, inflation that we're seeing affect my financial plan, the ability to fund goals, etc. Maybe how long will this high inflation last? And as an advisor, does your philosophy rely on historical data, market indicators, or both? So that is, again, where we're going to start today, talking about those inflation rates, giving some context to them, and then we'll talk about, really how to use a financial plan to navigate really the questions that are in front of us here. So when we're looking at inflation as a really important variable in financial planning, we of course have to make some fundamental assumptions. And all of you here today are Right Capital users, so we're really talking about this in the context of Right Capital. So again, what you're used to seeing in your default login to Right Capital, if you haven't made any changes, is that we use general inflation rates set at 2.5%, which affect all of your expenses that you're mapping out for your clients. We use healthcare cost inflation, that's a little bit increased at 5%. College cost inflation increased again at 5%, whether that's pre-college costs or college costs. And then we also see Social Security cost of living adjustment default in at 2.5%, as well as tax inflation defaulting in at 2.5%. And again, these are the base default assumptions that come with your software to Right Capital. But as we look at these, these might not be aligned with your unique advising philosophy, and you might be looking at different assumptions that you are interested in inputting. So we're going to go through some of the historical context, but I also want to address here the fact that these are global settings that can be used in Right Capital, but they're also customizable settings both at the advisor level and on the individual plan level. So if you believe a certain set of assumptions are what you want to use, but you have a client who is, let's say, really set on showing higher healthcare cost inflation or a higher general inflation data point, you can certainly adjust that individually. But as we mentioned earlier, the consumer price index is a common, resource used to be able to analyze, let's say, year over year inflation as it's reported to us. Now, at Right Capital, this is essentially representing that general inflation factor, and this consumer price index for all urban consumers, is representative of, essentially, the buying power for, a basket of goods and services that's often used across the US to indicate what that headline inflation amount is going to be looked at as. So understanding, of course, the historical context here is important. The year over year change in that here, we're again at Right Capital using right around 2.5%. We've obviously seen some significant spikes in recent years. We have, of course, had some significant spikes in the 70s and 80s, but we know that over the long term, when we're looking at averages, inflation itself is something that is going to be hard to project 40, 50 years in the future, but we can do our best to set something that we can explain to clients and that they can feel confident in. So again, just a little bit of background here. Sources are there. If you need more details or you want to adjust your information, Right Capital, that's where, of course, you and all advisors we work with have that freedom to align your unique planning philosophy with the future projections. In addition to that, we know, for example, cost of living adjustment for Social Security, like I mentioned, was set at 2.5%. Now, we know that since 1975 here, the average Social Security cost of living adjustment is actually more like 3.7% annually. And of course, we saw some record jumps in 1980 and 1981. Of course, we saw other record jumps in 2023 with an 8.7% increase. But we also know that although Social Security is intended to replace roughly 40% of income, of course, scaled for, lower earners are going to get a higher replacement value, higher earners are going to get a lower replacement value through those bend point calculations. We know that the trust fund itself, faces possible payment reductions in the coming years. So I'm going to give everyone some tips later on of how you can maybe bridge those questions with clients who might be asking, well, what if Social Security is reduced? What other strategies can we implement to increase our probability of success? Or how can we get additional guaranteed income within the plan that can help? So all of this, though, provides, again, that context behind, what do we want to use for Social Security, what we're going to call it, inflation, but cost of living adjustment is what we're talking about. And ultimately, how is that going to impact the client in the future? As well, we do, of course, have those variables of healthcare cost inflation and annual college tuition and fees for your clients in Right Capital and for your clients in general. So we do increase these by default in Right Capital to around 5% annually. We can see, of course, that the trends here are a little different from the Department of Labor and the National Center for Education Statistics, whether we're looking at, for example, different timelines, but ultimately at 5% for healthcare cost inflation and 5% for inflation for annual college tuition and fees, we are going to see, again, that data, meeting historical thresholds, but also showing maybe some projections that will be pretty astonishing to clients as they look to their future cash flows. So again, helping to put all of this in context can be really helpful to say, we're setting healthcare at 5%. We know our long-term care costs here are set for X amount, but look what they grow to 30 years from now. And again, we'll show that in a few minutes. But ultimately, overall, we know that in the US over the past 10 years, inflation is actually average, or I should say that from 2012 to 2021, inflation actually averaged only 1.88%. But we did see record inflation, of course, in 2022, and really over the past half century, we've seen it average around 3.9%, in spite of that recent spike. And ultimately, the Federal Reserve's goal is to keep that inflation between 2 and 3% annually. And with that optimum inflation, in place, obviously there's lots of conversations around, the Fed right now and the decisions that are being made. But we know that there are other market indicators as well that can help us to look into the future. Things like, the TIPS break-even rates, currently at around 2.2%. But, understanding both the historical references here that we can understand and use as reference materials and the forward-looking maybe data that we have in terms of market indicators, this can all come together to help you create recommendations that are really impactful for your clients. So when we're essentially looking to navigate this, it's first important to align your personal beliefs to the projections that you're working on clients with, to have a sound foundation to essentially help them understand the value in real terms of your recommendations that you can make. But there's one thing we know, which is money today is typically going to buy less tomorrow. We know that a cup of coffee in 1970 cost 25 cents, and in 2022 it costs $1.85. So one of the things that the Consumer Price Index doesn't do very well is really look specifically at the individual clients. And that's where we always like to recommend as well, really understanding the individual impacts for your clients. And one of the great ways to do that is to not only help your clients, with a comprehensive financial plan that includes, let's say, tracking their spending through a budgeting module or analyzing cash flows, but ultimately having that personalized inflation rate calculated can be really helpful, because some clients, let's say living in the city in an apartment, are going to have a much different inflation than a family of 4 living in the suburbs. So understanding the differences and the nuances of individuals' buying patterns can be a really important way to align the outcomes of their financial plan to a more realistic, let's say, or more accurate as possible approach as we project data into the future. And I know we're big fans of Michael Kitces here in his blog. What you can see, of course, we have linked his inflation rate calculation spreadsheet for personal inflation. That's a great one. It's a free resource, so would highly recommend that if you're looking to maybe get a little more information on helping clients actually evaluate that personal inflation rate, which can then be, of course, actually input directly into their individual plan in a tool like Right Capital to really help make their projections best aligned with the data you have. So monitoring those inflation rates, adjusting the planning assumptions periodically to help clients understand the impacts on their future goals is really important. And this might even be something that's done, on an annual or biannual basis, just to keep making sure that the plans, the recommendations are going to be, continually adapting to the markets around us. So ultimately, there are some tried and tested strategies for managing the impact of inflation, and Right Capital has great resources for you to help talk through those different strategies. And I'm really excited today to be able to really provide everyone that visual backdrop and that cadence that you might be able to use when you're with a client and you're using a tool like Right Capital to be able to talk through, of course, the impacts of high inflation today, but unknown inflation in the future, and understanding how those variables can impact the assets the client has, whether they're properties or commodities, or whether they're stocks and bonds and all of the in-betweens. Understanding how that asset mix is going to be essentially impacting each client differently based on these different inflation factors can be an important part of building a strategy for the future. And that includes, understanding the cash on hand and all the other variables that we can really help clients to think through and to essentially increase the purchasing power in the future. In addition to that, we know there's lots of opportunities for savings, but maximizing those to make sure, again, that we're able to keep savings, going to meet future retirement income needs that are ever inflating, and understanding even new savings opportunities that are available to clients in the near future, to essentially help bring that goal into reality for them of vacationing more or funding a child's wedding or even retiring early. In addition to that, we know that looking at the client's retirement income needs and creating a sound strategy for covering those is another big part of this conversation, all of which can be developed within a financial plan and demonstrated to the client of how much is a $10,000 monthly expense 20 years from now, and how can we make sure there's enough savings to cover that. So all of this also leads to the ability to take an existing strategy and actually stress test that against different inflation volatility and make sure that the clients are able to fully understand the implications of inflation being higher in the future, or inflation and longevity, impacting their life in a way that they didn't expect, or even healthcare costs becoming higher as well. So we can really target some of these individual variables to say, let's make a plan and then let's understand the impact of that and maybe stress test different options for the client to see what works best for them in the long term. And as we really talk about, reviewing the assets, it's, important to, again, understand that, sometimes inflation can be a good thing for those tangible assets. And we know that during periods of high inflation like we have today, those stocked commodities and property values tend to be increasing. And with that, if clients are in an opportunity to take advantage of that situation, maybe they've had a vacation home they've been looking to offload for a number of years and we're timing out the markets, there's obviously value here in looking at when they can get the most from those assets. And so that is certainly something that's part of the conversation today is, what if we sell an asset? What if we get the most from it? And then how do we take those proceeds and, again, make sure we're going to hedge our bets against inflation moving forward. We know that as well over time, with maybe optimal inflation rates, in check in the future potentially, we can see that as the purchasing power of cash falls, it can be a good time to actually purchase those tangible assets to promote, the value of the cash today that's essentially going to go down in the future. But in terms of the actual, asset allocation strategies, we know that over time, historically speaking, invested asset stocks, right, have outperformed inflation up until this point. And so investing maybe excess cash, can really preserve that purchasing power over time. So what that means is within Right Capital, for example, and other planning tools, potentially, you can run a liquidity analysis to uncover those maybe potential investment opportunities where we didn't know they were available. And ultimately, taking maybe excess cash or even excess cash flow and talking about, how that can be invested, but also how we can look at the current asset allocation strategy and ensure that, that is properly aligned with where the client wants to be. It's properly diversified, and ultimately, lacking in highly concentrated positions that could be really susceptible to specific inflation scenarios. We can really help the clients to achieve better outcomes for the long term. So again, we're going to look at all of this within the context of Right Capital as well. Beyond that, today we also know that there are significant savings opportunities for individual clients that they didn't have maybe even just a few years ago. So we know that the dollar today is not going to be worth as much as a dollar tomorrow, but appropriately taking advantage of saving opportunities can really help clients, of course, keep pace with inflation. And with new opportunities today, from things like the Secure Act, or even, just different tax efficient saving strategies that I know we've certainly talked about here at Right Capital quite a bit, and leveraging, that hierarchy of savings to fully fund those tax advantaged accounts as much as possible, we can open up more opportunities for clients to fund their goals in the future. And again, having visual cash flow reports to help really connect the dots with clients between, what are their current expenses, what's their current income, how much is maybe just being spent off that the client is unaware of, or what opportunities are there to save more, as well as looking at historical, spending with the budgeting tool, can really help to put a context to, how much are they actually spending, even though they tell you they spend 10,000, maybe it's 12 in the real term, and what could that additional $2,000 a month do for that client over the long term to help them fund their goals? Or, what if they maybe took that extra bump in their actual 401k savings to maybe take full advantage of employer matching in those employer sponsored retirement plans? Or even, as I mentioned, for the Secure Act scenarios, what are those additional catch-up contributions going to do for those clients that are maybe just now starting to be indexed for inflation? So in 2024, for next year, we know that IRA accounts are finally going to be, indexed for inflation with that catch-up provision. We saw that the actually just the standard contribution grow each year, but that catch-up just maintained static for a long time. So now, of course, the benefits are going to be available for clients over 50 to contribute more than they could have previously with that additional catch-up provision. In addition to that, starting in 2025, we know from that Secure Act update that those 401k plan participants age 60 to 63 can also contribute more. So we know that $7,500 catch-up contribution can increase to $10,000 potentially, or even more, with the potential for 150% of the catch-up contribution index for inflation. Still waiting on a little clarity there, but even if we erred on the side of caution with just $10,000 in today's dollars versus $7,500 in today's dollars, that it could be a big benefit to that client with the additional 4 years of savings there. We also know that there's new opportunities to contribute to Roth accounts as well, and additionally, an increased catch-up limit for simple plan participants, again aged 60 to 63, to the greater of 5,000 or 150% of that catch-up index for inflation. So all of this means not only do we have inflation front and center in the headlines for clients over the past few years, but there's also new opportunities to save, and really great visual tools to help you leverage the recommendations you're making to clients with direct impacts of what it'll do to their taxes paid, to their invested assets at retirement, to their net worth at the time they pass away. And all of that can be clearly demonstrated, again, with a planning tool. So we'll be getting there shortly. But the last component here is really talking through specifically a thoughtful retirement income strategy for the clients, and understanding that the dollar today is not going to be worth what it was, essentially in the future. So with that, we need to be able to plan appropriately for those, inflation, components of expenses. But we also need to understand that there's some nuance to all of this as it relates to, market conditions. And of course, unknown market conditions can impact future unknown inflation rates. So as we were looking at this retirement income strategy and developing this, it's important to understand that there's knowns and there's unknowns, and using a tool that can help to address some of those, what if scenarios, and help enter some of your own recommendations as it relates to changes in inflation based on things like market performance, can be a really big value add to these types of conversations. So let's get into it here. We know that typically, if you're working with a pre-retiree, you might be first trying to understand what kind of income need are we trying to fund over retirement. And many retirees, of course, want just the flexibility to spend what they need to, but conversely, no one really wants to deplete their assets halfway through retirement. So typically we're looking at what are the fixed expenses that we need to cover, and what kind of guaranteed income streams can we use to cover those. So the property tax that's not going away anytime soon, maybe the insurance premiums, maybe some of those other fixed costs that aren't going away. Those are the foundational component of what that retirement income need looks like. Additionally, we know healthcare costs as well are a big part of it. Understanding what are the future expectations for things like Medicare premiums, or even long-term care costs that we want to be aware of. And lastly, maybe just those lifestyle components. These are, of course, a little more flexible, but understanding what kind of ways do the clients want to enjoy their retirement, and how can we fund that appropriately. So looking at these as the foundational components of what the retirement income need looks like after the client stops earning money, switches over to actually that those retirement years before RMDs kick in or before Social Security kicks in, can be a really important part of solving this puzzle for the clients. But then, of course, understanding how those individual costs grow is where these additional kind of components come into play. And that's where I do want to bring up some of the really kind of important tools that we can leverage within something like Right Capital, which are ways that we can look at, of course, at that retirement income need and adapt it within the different market volatility trials that we actually project within Monte Carlo. Because we know that in a linear growth assumption with baseline growth projections, things might be represented pretty well without maybe the need to insert additional recommendations or what if scenarios to be able to make an approximate estimate of how much the client will have, and how much can they fund at a certain age. But we know that in a tool that has advanced Monte Carlo calculations, we're seeing 1,000 different market trials. And within those 1,000 different market trials, we can see everything from recessions very early on to very strong market performance early. And we know those sequence of returns can have a big impact on how long the client's assets will last and how long they can fund that income need that you've calculated. So what's great is that Right Capital does allow you to include something like a guardrail strategy, which is based on the Guyton Klinger decision rules, which really focus on specifically component one, the actual withdrawal rule. And what that means is essentially if portfolio return is negative in any of those Monte Carlo trials for a specific year, we can choose whether or not inflation is actually applied to that retirement income need. So if we're saying that we're trying to spend $10,000 a month, aka $120,000 a year on our retirement income need through retirement, and that's what we're trying to fund, our inflation rates would typically be applied. But if we're seeing an actual market trial where there's lots of volatility and negative returns or zero returns, the system can actually say that maybe in the real term or the real world, you might be making recommendations to that client if their portfolio value is going down to maybe not increase their expenses as they planned on that year, or maybe cut back a little bit to let those investments continue to grow and maybe rebound after a market crash. So in applying something like a guardrail strategy, we can take those kinds of recommendations and actually apply them within 1,000 different Monte Carlo simulations to show clients within these simulations how your recommendations can help them to essentially achieve better outcomes for the long term with their financial plan. And there are a few other components here for this guardrail strategy beyond that, inflation scenario, where returns are negative and inflation may or may not be applied. There's also a capital preservation rule, which makes sure that, again, we're able to adjust spending based on how much the client is drawing down from their invested assets. So let's just say, the clients are, utilizing William Bengen's 4% rule, where they're targeting 4% withdrawals from their invested assets each year to fund their retirement income needs. We would see that if markets did really well and the withdrawal rates actually, go below a certain percentage, we might decrease spending. Or if the markets perform really poorly and there's an increase, in the withdrawal rate, essentially how much we're taking out as a proportion of the invested assets, we might be cutting back on spending a little bit by a certain threshold. So these kinds of changes can help us to, again, modify future projections within something like the Monte Carlo analysis to better accommodate the real world recommendations, again, in maybe high inflation scenarios or poor market scenarios that you might be making to your clients. So, again, as we look at this as an example, if we're looking at a scenario where the portfolio return is negative, we would see that inflation would not be applied to, what we call that retirement expense or the retirement income need. And we're really talking about that same variable there of how much are we trying to fund, right? How much are we depleting our investments by to ultimately, meet our funding goals? So beyond that, we know that if, we need to make sure we're cutting back a little bit on spending, we can do so before a certain age. And if we want to spend more because the markets are doing really well, maybe that's applied as well. So it allows us to, in essence, limit the range of potential outcomes within 1,000 different Monte Carlo trials by taking the recommendations that you might be making in the real world and applying them to those 1,000 different market volatility trials that we run with the Monte Carlo. So as we take all this information and we talk about it, within the context of a case study, it really comes together just how powerful this can be. So this is going to be a typical pre-retiree case study for us. We have Mandy and Mike. You might be familiar with them. We talk about them quite a bit. Targeting retirement age of 67. We have a household income of around $200,000, planning to take Social Security at age 70. They're currently planning to spend $10,000 a month at retirement as their income need they're trying to fund. They have a fair amount of cash on hand. They have a fair amount of invested assets. So what we're going to do today is look at how this particular case study maps out with the strategies that we've spoken about within a financial plan in Right Capital. Again, we're using a Right Capital tool today because you're all users, and we certainly want to give you context that you're familiar with. But again, if there's other planning tools, these are the strategies that are really beneficial to being able to map this out. So if you look at Amanda Brady, we can remember what those common questions might be for her and Mike. What kind of impact does maybe higher inflation have on my ability to fund goals? Or, how long will this last and how do we show that? So I will say right off the bat that one of the best places to address those kinds of questions and identify the problems that they can have on a financial plan is in our retirement analysis, in our stress test. But before we get there, I again just like to provide a quick review of the case study today. Mike and Amanda, age 56 and 57, we're targeting $10,000 a month for pre-retirement and retirement. We have savings of around 4%, even though there's maybe matching opportunities up to 6% with the employer contributions. We also might see that this household, as I mentioned, has around 200,000 of total household income. They have plans to fund, let's say, those retirement expenses at $10,000 a month, as well as, keeping around 120,000 of cash on hand. And we have around $1 million of total invested assets. Now, as I said previously, those fundamental assumptions that we talked about are important to remember. So you can assign them globally in the advisor portal, but as a quick refresher here, in the gear icon settings for each individual plan, you can talk about what does, for example, general inflation look like, or what does education cost inflation look like, or tax inflation, which will increase, for example, standard deduction amounts, or IRS, the actual tax bracket income thresholds will grow by this assumption. We also see things like healthcare cost assumption and Social Security cost of living adjustment. And just for kicks, if you wanted to showcase what the reduction in Social Security might look like over time, if you want to show only 40% of Social Security being, applied to the plan, you can do so pretty easily there as an adjustable variable. But this information is important because just as it stands, you can see how important those variables are. So with a pre-retiree, for example, where we're planning on 59,000 of long-term care costs in the last 2 years of that client's life. So we're looking at 120,000 total cost in today's dollars. We can see that grows in the future substantially within the cash flows, or we could look in the insurance area to see this. But in the cash flows, we'd be able to see specifically what does that expense grow to. What does that healthcare expense grow to? And here we can see that at age 94 and 95, respectively, that we're well over, 600, or we're well over $700,000 of total expenses for Amanda and Mike, which means that 50,000 a year growing at 5% annually really has some significant impact on the plan. And that's something, again, that will be important to manage as it relates to the total costs we can expect. And same goes for living expenses, right? We know that those are growing significantly from 120,000, right up to over 300. So that raw data is here, the inflation data is there, but what if inflation is higher? Well, we can look at the client's probability of success, and here we can see the current plan at 71 is reasonable. We have 710 of the 1,000 Monte Carlo trials being able to fully fund the client's life and goals. But as I look to the stress test, for example, this is going to be a great place to say, here we are at 71% probability of success in the current plan, but what if inflation is higher by 1%, let's say? So instead of 2.5%, what if we're looking at 3.5% for general inflation? Or what if healthcare costs are higher? Or what if Social Security is reduced, or there's more longevity, right? So we can see how these different scenarios are going to be impacting this client by using this stress test and uncovering areas of vulnerability. So here we start at 71% probability of success, but as we increase inflation, and maybe that question comes up of, well, what's the impact if inflation is higher? We can see that there's some significant issues here. Now, this is where we can then launch into those strategies that we discussed and the benefits that those can provide to that client for the long term. So the first thing we might be doing is analyzing their assets and their investments. And so I might be looking to, let's say, that asset mix, and I might notice that there's a fair amount of cash on hand. And as I look to the liquidity module, Right Capital is going to be designed to talk through what does the target liquidity look like for this client if maybe they want to have a certain amount of months of living expenses on hand to be comfortable with their current situation. Here I can indicate maybe they need 6 months of living expenses. I can see the actual liquidity of 160,000. I can see a target of 60. I can see a surplus of 100,000 in cash. I can see the breakdown of this as well by looking at the details, where I can see there's some cash holdings in the investment accounts. We have 120,000 in a bank account. So what if we reinvest 60,000 of that cash on hand to help combat the impact of inflation deteriorating that cash over time? And maybe we want to know how that should be invested. And so as we look to the investment tab, we can analyze that client's current asset allocation mix and talk through maybe where we want them. as a pre-retiree, maybe instead of starting at around a balanced portfolio, maybe they should be in a more moderate portfolio. And beyond that, how can we make sure, we're appropriately, reinvesting that money? Well, we can look at the current client's equity sector and style and see maybe where they're overweight and underweight within the certain market indices. We can also see the breakdown of style here, and overall, for sector and style, that'll give us some direction, but we can also look to make sure that the client is not overly concentrated in any one position. And we could even list, specific, thresholds of what we might talk to as, different concentration amounts. So with that, we can actually look at this plan and say, well, in the retirement analysis, we've built out, let's say, an inflation management approach. So I've built a new plan saying inflation management, add a little, sword fighter there, why not? And so here in the action items, I can say specifically, what if I want to make those changes? What if I want to, for example, let's say change that cash on hand from 120,000 to 60,000, automatically reinvesting the rest. And this is what we call a cash reserve goal. It allows us to change on the fly the amount held in cash. The rest is automatically reinvested. So this simulates automatically reinvesting the remainder. In addition to that, what if we look at, that asset allocation that we start with today? Maybe we want to move towards more moderate asset allocation. And in addition, we are looking at the savings. We know maybe there's just simply some opportunities here to take full advantage of the company matching, which we can get a 50% match up to 6%. So why not just increase our 4% contribution to 6%, because maybe we've uncovered some cash flows that are available to the client. So here we have analyzed asset allocation, taking advantage just of employer matches here, and maybe even taking advantage of adjusting that retirement income need and the retirement spending to the guardrail strategy, where we're actually adapting the inflation rate when it's applied based on the market conditions. So as I change that to the guardrail strategy and hit refresh, we can see that that's going to have a pretty significant impact on the plan. But moreover, as I visit the retirement stress test, we can talk about not only, the changes that we'd see with inflation within that current plan, if inflation is higher by 1% or the clients live 5 years longer, again, reducing from 71 to 57 or 39, but I can then flip to the inflation management plan and actually see how much better those plans are performing. So now we're actually just, going down to 83% probability of success and 83% for longevity. And those are very empowering data points that can help the client to understand that the recommendations and the strategies that you're using for the projections are working within the Monte Carlo analysis. So all of this can really come together to create a really robust output to demonstrate the value behind that. And again, if we're looking at this in the context of the software, we can see that here, but an example of a quick report that could convey that information within, let's call an inflation management report. Maybe we're looking at the client's balance sheet, their liquidity analysis, and their budget. That would give us an idea of the cash flows, excess cash, what we can do additionally that we're not doing today. Maybe we want to look at the investments as well, the investment asset allocation, the trajectory of the asset allocation over time, sector and style, concentration. And in addition to that, we're going to look at the retirement analysis and maybe just a few of the cash flows to help, walk through some of that information. And we can then lastly summarize some of the information that we had within the stress test and provide some data entry information overview within the blueprint and maybe move this first. So we have a logical thought process of here's where we are today with the data entry, the balance sheet, the cash flows. Here's the invested assets and the analysis and the stress tests and how we're combating inflation overall. And that can be a quick download to really provide a great overview of how we can use strategies like we've talked about today to essentially manage inflation for the long term. And this could even be easily saved as a template if needed, but using the tool to show the value in a real scenario can be very powerful and can provide that additional alpha to your recommendations to your firm and for your clients. So here we can see, again, just, what that report might look like, maybe a quick blueprint overview with Michael and Amanda, the goals over time. We can see things like their, balance sheet overview for data. Again, we kept it very simple for this projection. We can see their liquidity analysis with any notes, the asset allocation recommendations. We can see their, actual Monte Carlo analysis projections, even that retirement income plan over time of how they're funding their goals, right? We know that, we're going to look at different savings withdrawal rates. We can see different funding sources, and eventually the stress test that's going to talk through why the inflation management scenario is going to be better off for them in the long term. So all of this, can help to, again, be the visual backdrop to the recommendations that we've been talking about today. But our goal is to help all of you, understand not only the different, conversations that you can have with clients, but also, help to make sure that they're able to see the real implications within a plan with those applied. So we hope that these types of conversations allow you to really, not only, work with existing clients in a more efficient or impactful way, but it could also be a great opportunity to differentiate yourself with prospects. As we know, this is a very popular conversation, and certainly, right, capital can be used as a backdrop, but you can use your own case studies like we've used today to actually talk through this as an example and discuss the value of making a few small changes that can have a really big impact over the long term. So we'll be opening this up to questions. So we'd love to hear from you, and ultimately, we'd love to be able to talk through all of this as well. Great. So can you talk more about the cash reserve goal? Absolutely. So I think that's a really important part of the conversations that you can have with these reinvestment strategies. So one of the things that's important about the cash reserve goal is it's not automatically applied to every plan. So as I look at my financial plan here under profile goals, I have essentially set this financial plan up to include a cash reserve goal, which is going to be listed here because I'm not automatically treating bank accounts as cash. Rather, I'm using this cash reserve goal to indicate how much cash on hand I have. So if I was using this setting and I didn't have that cash reserve goal card, this bank account would not automatically be treated as cash. Rather, it would be reinvested in the taxable brokerage account that's currently based on a balanced 50-50 portfolio. So that is something that's an important data point. So if you're using this cash reserve goal, which helps to show reinvestment strategies, you just want to make sure you have the data entered. But to turn that on, it's as simple as visiting your settings in the gear icon settings and choosing within the methodology area that you'd like to use a cash reserve goal to manage cash levels instead of just automatically treating bank accounts as cash. But again, the value in this is that I can then very easily toggle the dollar value around to show different implications for reinvestment strategies. So by changing this from 120,000 into 60,000 in cash, that's immediately reinvesting $60,000 into the asset allocation that I choose. So certainly worth mentioning there, and thanks for bringing that question up. I think that's a good one. Another good question is, how do we get more information on the guardrail strategy? So in this instance, the guardrail strategy is occurring. You'd be able to see it occurring specifically as you look maybe at the retirement details, which does show you the breakdown of course, retirement income sources, which is really helpful, but also you can see that, actually that the breakdown of expenses and how they change over time. So if we input negative returns, for example, I'll have to redo these, but if I input negative returns, we could see the guardrail strategy adjusting our retirement income need over time based on the information we provide. So that is important, but in the Monte Carlo, it's happening within 1,000 different trials, and you can always get more details on that under the models tab by visiting retirement spending and visiting the guardrails strategy. So this will tell you, are you in fact using no inflation adjustment if the previous return is 0 or negative on that retirement income need? So that's an important variable that can be applied. And you can even toggle the rest of this off if you only want this component applied. So it's very flexible. For example, maybe this is only inflation adjustment here for guardrails, and I could set that up again. Check that off. I could switch it to guardrails. I could make that work, and then I could just say no change with the other two, and this would only impact this now. So this could then be applied in any of the client plans as I visit the retirement expense scenarios. Perfect. So let's just quickly talk through where that comes in. Again, retirement income need here. Here we could see only inflation, and that would be how it's applied. Wonderful. So again, the global assumptions, everyone, just for the answer to this question, are located here under the assumptions inflation area. These are important components to align with your unique advising philosophies. We want you to believe in these data points so that you can explain them to clients. And of course we have our disclosure, but if you ever needed to add your own data into the disclosures for PDFs, you're welcome to do so in the gear icon account customization area, or I should say, I apologize, gear icon account profile area, where you can add in any changes to your report disclosure if you'd like. So you can include any additional information. Great, perfect. So this is another great plan. Another great question. If I created a goal in 2023, or I should say, if I created a goal today in 2023 to buy a car in 2030 for $50,000 in the cash flows, it shows 60,000 for the car because of inflation. Yet the next year, 2024, the cash flow and the plan for the same goal would show 58,000, not 60. How is this handled, and what can we do to adjust this? So that's a really great question, and that has all to do with this little section at the bottom of your assumptions area. And it says for cash flow items in selected categories, if the start date is in the future, we will inflate it between today and the start date. So what's likely happening for you is maybe the checkbox here is impacting how we're inflating this in the future. If you're seeing that it appears to be operating in a way that you aren't expecting, just know that you can always reach out to the support team, and they can take a look with you. They can log in with you, look at the exact inputs, and that's going to be a good option for you. But definitely worth checking that checkbox off and taking a look at it. Great. Good. We have some feedback here. Perfect. Great. So everyone, it looks like that's it for questions. We genuinely appreciate all of you, as always, joining these webinars. We're going to be submitting your CFP CE credits by Friday afternoon. If you did not enter your CFP ID upon registration, feel free to respond to the follow-up email you'll get tomorrow. But everyone looks pretty good at this point. So we appreciate you. Hope you have a wonderful weekend, and we'll see you next time here at Right Capital.